In this video, guys, we're going to look at 3 trading strategies for part-time traders. Stay tuned. Hey guys, warm welcome to you. All right, so 3 trading strategies for part-time traders. This one's my favorite, but let's start with number 1. So number 1 is called the open driver. Now I'm going to assume you know how to place orders, you know how to place stops, you know how to place limits, and maybe you know how to place orders at specific times, whether that's using your phone at a certain time or whatever. I'm going to assume that you can manage the risk on these, but some ideas of trading strategies that may well fit in with your lifestyle. So the open driver, okay, so the open driver is you buying or selling at the market open, and that's up to you to decide how you're going to do it. So you're analyzing the night before, perhaps you're analyzing the US session for trade the European session, maybe you're analyzing the European session, trade the US session, the Asia session, etc. You know what I'm talking about. So this is the open of an equity market. So you're going to trade either the DAX, you're going to trade either the FTSE, the CAC, or you're going to trade Euro stocks for Europe. I would recommend either the DAX or the FTSE, in my opinion. Or US, if you're trading the US Open, which is 2:30 UK time, you're going to trade the Dow. If you're going to spread bet, if you're trading futures, maybe you want to trade the NASDAQ or the S&P 500. And you could also trade early hours of the morning Hang Seng or Nikkei if that fits in with your lifestyle. So you're going to buy and sell at the market open. So it's either you're going to log on and literally buy and sell based on your analysis of what's happened, and that's your guess if you like. But the important thing is you're going to have a stop and a limit. So you're going to say, right, I'm buying at the open here. I'm going to have a 25 tick target. I'm going to have a 15 tick stop. So literally your buy order goes in, your bracket order goes in, you're done. Okay, maybe even that's extended. So maybe even go, right, was a 100 tick target, 50 point stop, looking for a trend day. So you can adjust that to suit how long you want to be in a trade for. Obviously, smaller targets, smaller stops, you're going to be trade for maybe 15, 30 minutes. You're going to be in for a whole day, maybe looking for a 100 point stop, 200 point target. Again, so you can play around with it. But this is based on the fact that most of the time, the high or low is done within the first 15 minutes of the day. Now, you're not always going to get extension day, but you might well get a day that drifts up and just enough to tag your limit and take you out of the trade before it kind of rocks back to the mean. Of course, if it goes against you, you've got your stop in to protect that. You've got to make sure that one of the orders are OCO. In other words, one cancels the other. So if your stop's filled, it cancels the limit. If the limit's filled, it cancels the stop. Very simple to do. All right, so that's the open driver. Number 2, the overnight drifter. So very often overnight, prices are going to drift further and further and further and further, and there's obviously a good trade to be had overnight. So that could be with a currency pair. That could also be with a futures contract. So spread betting firms as well are going to allow you to trade the indices all throughout the evening. So you can do it that way, or you could trade a currency pair in the evening. So what do I mean by that? So if you're trading like GBP USD, for example, the evening will be when London's asleep and US is asleep. If you're trading something else, you've got to know when both of those pairs are asleep. So it's when it's an overnight session when trading is not happening with the underlying. So you'd be trading the DAX in the evening, that would be kind of 9 o'clock in the evening up until perhaps 6 o'clock in the morning, for example. You get the idea. So the theory is that you can position for a move overnight. So yes, a lot of the kind of volatility happens during the day, but there's nothing to say you can't, before you go to bed, assuming you can sleep like this, guys. Don't want to make it so you can't sleep. Assuming you can sleep with the position on, you can think, okay, we'll have a trend day. I think if we kind of drop back a little bit, we might push to new highs. So you can bid maybe 30% of the trend move down. You can have a stop there and your limit at fresh highs. You can structure it how you want. The point is you're putting like a bracket order in at some point. So you're putting in your buy. If you're long, there's your stop, there's your buy, and there's your limit, okay? And whatever point in the chart, you're putting that in and it's being executed for you. So that's one way of doing it. All right, number 3, guys, bracket the market. I like this one. I think this is my favorite one of the lot. Bracket the market is that you are basically looking at the intraday movement, the likely intraday movement. ATR, average true range of the day. Let's say it's 200 ticks, for example, 200 points, 200 pips, however you want to look at it. And let's say that's what you expect. That's the expected range of the day. So what you can do is you can put a bid in, i.e. an order to buy, at, let's say, half the ATR, or 2/3 of the ATR, or 1 ATR away from the opening, from the prior close price. So if the market comes down and hits it, you're going to get filled, you've got to stop below it, you've got a limit order above it. Again, you've got to have this kind of bracket system, being able to trade that, but that's very simple to do. And you also have an opposite sell order. So you have a sell order in that's above the market. So yes, of course, those must also cancel each other out if one of them gets filled, the other doesn't. But the point is with this is that you are basically relying on the market the majority of the time to stay within a range. Now, of course, you can judge that range. Sometimes it's not going to go straight off and go from the open to 180R. It might go down a little bit and then go up, which is why you might want to use 180R. You might want to use half an ATR. But what you're doing with this is you're saying, I don't know where the market's going to go, but I know that the likely scenario is that it will extend and it will come back at some point. And so you're trying to judge where that extension is based on prior movement, prior price action, the ATR, etc. And you're placing orders in the book for that, or orders, resting orders with your broker. And so you're saying, I don't know which direction it's going to go, but what I'm saying is I think that it's going to stretch up, struggle and come back, or it's going to push down, struggle and pop up. Either way, I want to be positioned for it. So that is not a bad way to do it. So anyway, guys, those are 3 trading strategies for part-time traders. Of course, it's just my opinion. These are very loose foundations. You have to go a lot more depth to discovering, where exactly you want to put your orders, but they're kind of the outline, if you like, of how to potentially use the fact that you can't trade during the day, either trade at the opening driver, either trade at the overnight drifter, or bracketing the market during the trading day if you can't actually be there, but at least there you're to catch those little extreme moves if they happen. All right, guys, take care. See you next one. Keep your risk manager, whatever you're doing. Super important. Bye-bye.